Okay, this last example, I want to walk through a scenario wherein we do not meet the tests for finance lease, and so we have to classify it as an operating lease. So in this example, we already know the equipment reverts back to Connor. There's no purchase option, so we know we didn't pass the first two tests. I changed a couple of the parameters of the lease. The term of the lease is 4 years. The estimated useful life is 6. So now we have a lease term that's only 67% of the estimated useful life. So we do not pass the economic life test. And then we calculate the present value of minimum lease payments, which with unguaranteed residual value, we would not include the residual value. And so what we're looking at is present value of minimum lease payments of $51,772 because of the higher residual value. And if we take that as a percentage of the fair value, it's only 86%. So in essence, we don't meet the present value test either. And with a residual value of $10,000, it's safe to say that there is alternative use for this asset. So bottom line, we have failed all of the tests to account for this as a finance lease, and we will therefore account for it as an operating lease. Let's first look at Vaden Company. On January 1, 2020, we'll record just like we do always, and that is debit the right of use asset and credit lease liability. The thing to remember here is even though it's an operating lease, we still, according to FASB, are going to capitalize the asset under the assumption that we have procured the right of use of that asset, or we are procuring it over time. We will, on January 1, make our first payment, which is $13,905, nothing different there. Now, it's the end of the year where our entries change. So if we look at the amortization table that I put together, it's a little different. We're still going to take care of interest using the effective interest method. That has not changed. So you will see my calculation for the interest at 5% of the lease liability balance. The difference is that the amortization of the right of use asset is not going to be based on the original asset value divided by the lease term. It's going to, in essence, be a plug that results in the total lease expense for the year being the same. So 2020, here we go. 2020, my right of use, amortization of right of use is going to be $12,012 because that's what is necessary in order to make up the difference between the payment amount of $13,905 and the interest amount. And so if you go back to the journal entry at 12/31, you'll notice the lease expense is one line item. We didn't divide it out between interest expense and amortization. It's one line item equal to effectively the interest payment or the lease payment. Then our credit will be a credit to the lease liability for the interest portion and a credit to the right of use asset for the amount of amortization. And then January 1, we debit lease liability and credit cash. 12/31/2021, again, the lease expense will be exactly the same every year. The only difference is the portion that gets credited to right of use asset and the portion that gets credited to lease liability. And then we go through the remainder of the lease term in the same fashion. Okay, so we have one line of expense related to the lease, and it's the same amount every year. Now, here is what happens with the lessor. For this operating lease, it is not deemed from the lessor's perspective to be a sale because we did not meet the criteria that implied it was effectively an installment purchase. So Connor Company, the lessor, does not record any revenue. They do not record any cost of goods sold. They don't even remove the asset from their books. What they're going to do on January 1, 2020, they're going to debit cash for that first payment, and they're going to credit unearned revenue because they're earning the revenue by virtue of allowing Vaden Company to use the asset. As of January 1, Vaden Company hasn't used it yet. So at 12/31/2020, there'll be an entry to debit unearned revenue, credit lease revenue. At that point, Connor Company has met their performance obligation. And then January 1, then on January 1 of 2021, they'll do the same thing. They'll receive the payment, debit cash, credit unearned revenue, 12/31, transfer the revenue, unearned revenue into revenue because they've met their performance obligation. And effectively, these will be the exact same entries every single year. Now, the only other entry that they would make, which I did not include here, is because Connor Company has this asset still on their books, they would continue to depreciate it. So you would see depreciation expense, any expenses related to maintenance or insurance or anything remaining on the books of Connor Company.